You spot a textbook chart setup. The indicators align perfectly. You enter the trade and immediately get stopped out for a loss. Why do retail traders constantly bleed money on these seemingly perfect setups, while institutional money consistently profits? The flaw lies in the tools themselves. Traditional technical indicators like the MACD or RSI possess mathematical lag because they are calculated using historical price inputs. By the time the line crosses on your screen, the actual market move is already over. To survive in the markets, you have to choose your approach. Long-term investing focuses on fundamentals and wealth compounding. Active trading operates on minutes, carrying higher risk and relying on real-time supply and demand. To trade actively, bypass lagging indicators. Successful traders rely strictly on price action, the pure footprint of institutional order flow. If you base your entries on a delayed mathematical formula instead of the raw price on the screen, you aren't finding an edge. You are simply providing liquidity for the institutions. Price movement is not a mathematical certainty. It is driven entirely by human behavior, specifically the imbalance of urgency between institutional buyers and sellers. This is a raw price chart, and it shows exactly how that urgency looks. On the far left side, we see an initial steep downward bear trend. This indicates absolute certainty and urgency among institutional sellers. But look at the central horizontal section of the chart, where the price action flattens out into a tight range. This is a tug-of-war representing institutional uncertainty, where the price simply bounces between an established floor and a ceiling. Notice the specific upward breakout at bar 2. It briefly exceeds the range ceiling before immediately reversing. This is called a Wyckoff spring, or a stop hunt. Institutions intentionally push the price just high enough to trigger the breakout alerts of retail traders, generating the liquidity they need to execute their own massive orders. This mechanic creates a one-tick failure. Retail traders confidently place their buy stops right above that breakout line. The moment those orders execute, institutional sellers absorb them, immediately rejecting the higher price. With the retail buyers trapped and forced to sell at a loss to cover their positions, the institutions use that cascading liquidity to aggressively drive the market in the opposite direction. This causes the vertical collapse you see here at bar 3 on the far right. In ranging markets, trying to force a trade on a breakout is a trap. True price action mastery means practicing patience, waiting for the weak hands to be flushed out, and only entering alongside the institutions. Moving from theoretical chart reading to actual trade execution requires a professional framework. You follow a strict 3-step setup. First, identify the macro context. Are you in a trend or a range? Second, wait for the price to reach a key support or resistance level. Third, identify a clear confirmation signal at that level, like a pin bar rejection. When you execute the trade, you must place your stop loss defensively. Instead of placing it immediately at the bottom of the signal bar, you set it further away, entirely outside the Wicks Wick-Raying pool. This buffer prevents you from being taken out by manipulative one-tick failures. Next, you verify the math. A valid setup must offer a minimum risk-to-reward ratio of 1 to 2. Because losses are an inevitable part of trading, your winning setups must pay out at least double what you risk. But the most flawless mechanical strategy will fall apart without psychological discipline. The ultimate difference between a gambler and a patient market participant comes down to emotional control. Whether you are investing over decades or trading over minutes, financial success is not about mathematical prediction. It is about the ruthless, disciplined execution of behavioral patterns.